It all started with a single political move that sent shockwaves through global markets. President Donald Trump's nomination of a new Federal Reserve chair, widely expected to favor tighter monetary policy, triggered panic across financial systems. In a matter of days, gold plummeted, silver collapsed, and Bitcoin, once hailed as a digital safe haven, tumbled dramatically. Investors watched in disbelief as portfolios that had seemed untouchable evaporated almost overnight, leaving even seasoned traders scrambling to understand what was happening. This wasn't just a market correction, it was a sudden repricing of risk, driven by policy uncertainty, currency strength, and global investor psychology. Understanding why this crisis unfolded is critical for anyone navigating today's volatile markets, and the following 7 points break down exactly how it happened and what it means for investors in 2026. Let's watch. 1. The Fed nomination shattered market confidence. The nomination of a new Fed chair, who was widely viewed as hawkish, triggered immediate panic across markets. Investors who had grown accustomed to years of accommodative monetary policy suddenly faced the possibility of tighter credit, higher interest rates, and less liquidity. Gold and silver, typically considered safe haven assets, fell sharply. Investors assumed they would protect wealth in times of uncertainty, but the stronger US dollar and looming interest rate expectations made these metals less attractive. Bitcoin, often treated as a risk-on asset, but sometimes framed as a hedge against fiat currency, also saw a steep decline as traders rushed to cash. 2. So Bitcoin collapses under market pressure. Bitcoin, despite being decentralized, was not immune to the shock. The crypto market had been riding bullish sentiment for months, fueled by speculation, optimism around digital assets, and hopes for regulatory clarity. The Fed nomination upended those expectations. Prices fell sharply as panic set in, fueled by investors exiting leveraged positions and hedging risk. The rapid drop was amplified by the fact that cryptocurrency markets are highly reactive to global sentiment and capital flows. For many retail investors, this was devastating, turning gains into losses within days. The crash highlighted a key reality. While Bitcoin is often positioned as independent of traditional finance, it is still deeply connected to global liquidity, investor psychology, and market sentiment. Optimism alone cannot sustain price levels when broader macroeconomic conditions turn against risk assets. 3. Precious metals. Sell-off defied expectations. Gold and silver, long considered safe haven assets, also suffered major declines. Their usual role as protectors against inflation and instability was upended by the stronger dollar and expectations of tighter monetary policy. Gold fell sharply as a rising dollar made it more expensive for international buyers. Silver, with its dual function as both a precious and industrial metal, experienced even larger swings, erasing billions in value. Investors who relied on metals to shield against market turbulence were shocked to see these traditional hedges falter. This unusual behavior illustrated that no asset is invulnerable. Even historically stable investments can become vulnerable when market expectations shift and investor sentiment turns negative. 4. Policy uncertainty fueled rapid selling. Markets hate uncertainty. The announcement of a Fed chair signaling a hawkish approach created immediate questions about future interest rates, liquidity, and central bank intervention. Investors feared reduced stimulus and tighter monetary conditions, prompting a repricing across nearly every asset class. Risk assets, including Bitcoin, gold, and silver, were hit hardest. Traders scrambled to reposition portfolios, leading to rapid sell-offs. The event underscored a central truth about markets. Expectations often matter more than reality. 5. The dollar strengthened, adding pressure. As markets absorbed the potential for tighter Federal Reserve policy, the US dollar strengthened significantly. A stronger dollar reduces demand for non-yielding, dollar-denominated assets like gold, silver, and Bitcoin because they become more expensive for international investors. This dynamic led to further selling as global investors sought higher returns and lower risk alternatives. Emerging markets felt the pressure even more acutely. A stronger dollar increased debt servicing costs for countries with dollar-denominated obligations, prompting investors to shift capital towards safer, yield-bearing assets. This created a cascading effect, with metals and cryptocurrencies facing intensified downward pressure as liquidity flowed out of perceived riskier positions. 6. Panic selling and emotional investing exacerbated losses. Investor psychology was a driving force behind the collapse of Bitcoin, gold, and silver. Fear and uncertainty, amplified by relentless news cycles and social media chatter, created a climate of panic. Many who had bought these assets during previous rallies sold quickly at a loss, attempting to protect their capital, but in doing so, contributed to a self-reinforcing downward spiral. Emotional investing chasing gains during hype and selling under pressure out of fear magnified the market's decline. Even knowledgeable investors, familiar with the fundamentals of their holdings, found themselves reacting to price momentum instead of adhering to strategy. This chain reaction underscores a critical truth. Markets can behave irrationally for extended periods, defying logic and expectations. 7. Lessons for future market volatility. While the collapse of Bitcoin, gold, and silver was dramatic, it also highlighted critical lessons for investors. Diversification remains essential. Spreading investments across multiple asset classes reduces the risk of catastrophic loss in any single market. Proper risk management, including thoughtful allocation and hedging strategies, can safeguard portfolios during extreme volatility. Equally important understands policy signals and global macro trends. Markets react swiftly to central bank decisions, political developments, and currency fluctuations. Staying informed and anticipating shifts allows investors to make rational, strategic decisions rather than reacting emotionally. Volatility is an inherent feature of modern financial markets. While sudden collapses are painful, they are part of the natural rhythm of risk and reward. The ripple effect of policy on markets. The shockwaves from Trump's Fed nomination are a stark reminder that markets are never immune to political decisions. Bitcoin, gold, and silver all fell not because of weakness in fundamentals, but because investor expectations shifted overnight. In confidence fragile and easily shaken drives markets just as much as supply and demand. By learning how these shocks unfold, monitoring trends, and maintaining a strategic approach, investors can protect wealth, capitalize on recoveries, and navigate an unpredictable financial landscape with confidence. In the world of markets, knowledge and discipline are the ultimate safety nets. Let us know in the comments what you think about "it started." Trump just broke. The Federal Reserve. Gold, silver, Bitcoin collapses, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.